Alright, hello everyone, and welcome back to another video. Thank you for subscribing. If you have not already, please try subscribing. I would really appreciate it, so please consider hitting subscribe and seeing my other videos. So what we're going to do today is we're going to go over Disney, because they have just had such a strong surge in Disney Plus. It's crazy. They're going to catch up to Netflix, I think, a lot sooner than people think, especially with shows like WandaVision, and if they just keep creating more and more original content. Disney has a vault and a treasure trove of their own movies and TV shows to keep them, well within the bounds of, creativity and great content. So anyway, let's get right into it. So if you had bought Disney during the close of, the pandemic, like not the close of the pandemic, but like on the worst day of the pandemic at the market close, you would have been around like in the 90s, in the $90 range a share. And today, as of March 3rd, 2021, it's trading at about $192, as you can see. So that's crazy. This is exactly what kind of stock you want to be in as far as a pandemic play that, when it comes out of the pandemic, should do a lot better. It should see a revitalization and, a stronger comeback and a momentum play because of their, streaming service. And basically, if they could create their own streaming service that has 3/4 the size of Netflix, that's like hundreds of billions of dollars of market cap, and that alone, never mind the Disney brand and everything else that's involved. So anyway, we have 19 total buys from analysts and 5 holds. So it's a strong buy rating at $206, which is about 7% upside from where it is right now as of today. The stock analysis itself is about a 9, which again is pretty strong. We don't really see that with too many companies, and it's a good sign. Let's get right into the financials. So their fiscal year ended in October of 2020, and so we could see that their full year was obviously a little. This is actually crazy because you know how Disney was one of the first places to shut down and to basically lose most of its business when there was the pandemic shutdown. So that was crazy because they basically had a small dip in revenue in 2020 compared to 2019. That is insane. You would have thought this would be half, like 30 billion. No, it's stated about 65 billion, and a lot of that is in part to the efforts of Disney Plus streaming. So if we take this number and we go down, we actually see that this is the first year that they had a net loss in quite a while. So Disney has been consistently, steady in their close to double-digit billion-dollar profit range, and this 2020 just did not help. They really had to pay a lot of expenses, it looks like, in order to, keep afloat, like almost $23.5 billion in expenses to keep afloat compared to, 2019 was its highest, obviously, at 16 billion. So, almost 17 billion, so about 6 billion more that they had to spend. That's crazy. That's a lot. That's a lot to ask for a company. So obviously they had a down year in that sense, but no one can fault them for that. They should come back strong. Let's look at the cash. Look at all that cash. Now, that's crazy. Let's look into that a little bit more, but look at that cash pile grow on an annual basis, almost 3 times. It's 3 times as high in 2020 as it was in 2019. Now, their total current assets is about 35 billion, and their total current liabilities is about 26 billion. So they have a good working capital. Not great, not that strong, but it's pretty good. That's not bad. Nothing to sneeze at. Total assets of 201 billion versus total liabilities of about 104 billion. And this is what we don't want to see. Their long-term debt went up, and it went up by a lot. And that's probably why they were able to um, increase their cash pile. They either issued new shares, which we'll take a look at in the cash flow statement, and they also, at the same time, they they put out a lot more debt out into the market, and that's not good. We don't really want to see that, but again, this is a pandemic play, and this obviously had to happen because Disney has cruise ships and stuff like that, and they had to, keep, and the whole theme parks, obviously, they had to keep some parts afloat, so they had to take out debt, which is probably, a good thing for the creditors, because you can see Disney's going to be a strong long-term play, especially since you know that they're going to have strong cash flows and revenues off of the streaming service, that by the time the parks come back, this will be a good deal for everyone, or it should be. Let's hope that Disney pays this down and keep an eye on this in the future. Anyway, so now let's go over to the cash flow statement. Obviously, we start out with net income, or in this case, a net loss, which is the first time in a while that Disney has had a net loss, but we obviously already know why. Now let's look at acquisitions. No, they didn't make any acquisitions, so they didn't buy anything, obviously, because they didn't, they didn't, their debt didn't come from that. We know that now, that they didn't issue debt in order to buy a company, and we know that this didn't affect its cash pile because the cash pile grew and didn't decrease. So I wonder what this is. Well, here we see long-term debt issuances versus long-term debt repayments. So they had issued 18 billion in new debt in 2020, but then they also paid off about 3.5 billion. And we can also see, let's see if we can see from investing activities the new shares created. And so far, I don't see anything. It looks like they stopped buybacks, so they did not buy back. And they also cut the dividend, which is also a really smart play. But I'm not really seeing anything as far as why the cash pile grew. And let's see. No, I still don't. So if you know, or if you see something on here that tells me why the cash pile grew for Disney, feel free to reach out and comment below. Anyway, let's look at a portfolio of Disney. So if you had invested in Disney when it IPO'd in April 1985, $10,000, and you had reinvested all the dividends, because it does pay a dividend, you would actually see today a total of $1.1 million. That's really incredible because that's about 14% compound annual growth rate, and it only had a worst year of about 28%. That's not that bad. That's not bad at all. And so if you look at the annual returns on Disney, then you can actually see that, as of like the last few years were some of its best years. So 2019 and 2020, it actually grew. The stock price actually grew. Obviously, early on in the pandemic, everything was up in the air and it tanked. It really, really, really did not do that well. So you would be pretty sore for loss of words to try to describe like how you felt if you were a shareholder when Disney basically looked helpless and everything was lost, which we could have lost Disney in the pandemic. It was absolutely possible if it wasn't run so smoothly. Anyway, this is it. Again, let me know what you think and comment below if you noticed anything about the cash pile growing, because I wonder how that happened. If they didn't make any acquisitions through, divest anything, I wonder how that came to be. They also didn't divest anything either. So anyway, yeah, let me know what you think and comment down below. Thanks.